Good afternoon, everyone, and welcome to today's meeting of the Board of Revenue Estimates. I'm Peter Francho, the Comptroller of the State. We've got Nancy Kopp, the Treasurer, Secretary, DBM Secretary David Brinkley, Mr. Schoffel, who's going to make a report to us, and we have Derek Davis, the newly elected Treasurer-to-be, also attending just virtually, and we welcome him. But I want to make just a comment about my dear friend, Nancy Kopp. Our friendship, Nancy, has spanned 35 years that I've been in politics. I think you were in, I don't want to say before that, but I joined you in the Maryland General Assembly. And frankly, for the past 15 years, when I got elected comptroller, we've served together as watchful stewards of the state's finances, not just on this critically important body of the Bureau of Revenue Estimates, but also on the Board of Public Works and also on the State Retirement Agency's Board of Trustees, which you have so expertly chaired. And the moment for us to separate is very bittersweet because I know the quality of your work for the last 46 years, what you've given the state of Maryland, not just as the state treasurer, but also as a legislator. And I know that because of you, Maryland's a better place. And I don't think you realize your impact on Maryland's communities and people that obviously is going to be felt for generations. But how about the impact upon people like me and others that have interacted with you? And I just wanted to thank you personally. I know we still have a Board of Public Works meeting tomorrow together on Wednesday tomorrow. But Madam Treasurer, it has been an honor for me to serve alongside you, and I wish you and Robert the very best. At this point, I guess I'd like to recognize the board's Executive Secretary and Director of the Bureau of Revenue Estimates, Andy Schoffel, for his report, unless Secretary Brinkley wanted to add some
Mr. Comptroller, those are magnificent words, and I had some comments to address
Nancy's departure
later, so we'll get there later.
Okay, great. Well, thank you.
I just want to thank you. It's been about 35 years, and it's been great ups and downs and ins and outs, but I think we've been great colleagues and friends. And I remember waving the Francho for Congress signs about 30 years ago, and I want to thank you very much for all, and look forward to continuing a friendship. And actually, with the secretary, former senator, former delegate, who sat across from me on the floor of the House, it was a good team, and there's a good team there. And I am just so pleased that Treasurer-elect Derek Davis, who also has served 27 years in the General Assembly, is with us, not on screen, but he's here, and I know that he will be a great colleague, and Maryland will benefit. Change is good, and this is good change. Thanks.
You. Andy, if you could make your report, please.
Yes, sir. I too would like to just piggyback on your comments and thank the treasurer. She's been a tough and constructive critic of the revenue estimates. She's made us work hard, prove ourselves. She's been excellent for the process, and I really, really appreciate your support and your work over the years on this board as the executive secretary. We would not be what we are without you. It's much appreciated, and just want to say thank you.
Thanks, Andy. Let me just add one more thing. It was 47 years in the House and treasurer, but there were 3 years before that when I was on the legislative staff. And I think that the staff we have in Annapolis, and the treasurers, the comptroller's office, Department of Budget and Management, and the legislature is what really makes Maryland a very strong state governmentally at the state level. And Andy, you've been terrific, and I know will continue to be terrific. And I thank you very much.
All right. Thank you, Madam Treasurer. And Alan, if we could pivot to the slides. Thank you very much. Heading into the presentation, I will do my best to keep the comments brief. This table is in here. I don't expect anybody to be able to see it or really look at it, but it's here as an artifact. It is also on the comptroller's webpage, so it is publicly available. It is our summary table, and here is a summary of the summary table. What you see here is that the estimates we're putting forth today would increase the current fiscal year 22, by $495 million, and the budget year, fiscal year 23, by $543 million. So what is a relatively significant increase in terms of dollars? If you look at it percentage-wise, it's only a 2% increase over the prior September estimates. So the dollars keep getting bigger. That's something we've talked about quite a bit in this evolution during COVID and the federal money. The revenue estimates have gotten considerably larger, and therefore so will the adjustments. And I do look at these December changes as adjustments. In September, we did the heavy lift of understanding the federal stimulus and the way it was flowing through the economy and into our revenues. This is a continued adjustment of that really structural shift that we took in September, where we increased the revenues significantly. Much of what we have here is money that is already in the door, and I'll get into that a bit more in detail. But we're writing up the income tax by $261 million in the current year, and the sales tax by $226 million. The income tax and the sales tax make up about 75% of the general fund, so they do drive the shifts. Corporate income tax we have down just a bit across both years. We expect to see an increase in refunds over these next 2 years associated with corporate income tax. But all in all, I don't want to give any mischaracterization. The corporate income tax is up very significantly from pre-pandemic levels. So the corporate tax base is quite strong. Don't let these estimates mislead you. And then the other, we have a hodgepodge of changes throughout the rest of the revenue stream. One of the more significant ones there is the tobacco tax. There were some pretty significant rate increases for cigarettes as well as other tobacco, and we underestimated the behavioral impacts of those changes a bit. So they are a bit higher in this estimate. So again, $495 million in the current year, $543 in the budget year is the revenue recommendation. Moving into the economics and the details. First off, we have to start with the COVID cases. Maryland is the black line there. The national number is the red. And as we're all pretty aware at this point, but I do want to point out, cases have been rising since the middle of November, and especially since the Thanksgiving holiday. Naturally, we all remain concerned that we could see something like we saw last winter. We know that the cold weather conditions are more hospitable to the virus, and we're all on alert. Naturally, any predictions we make are suspect to significant changes in COVID, and not just the virus, but government's reactions to it. And not just our own government here, right? We know that we are linked globally. Some of our challenges we have now are because of global supply chain issues. So decisions that are made outside of this country's borders could also have impacts on the estimates. And I think it's important to note this, not just from the health impacts and the impacts of ourselves, our families, and our neighbors, but this is global, and that matters to the revenue estimates. Jumping into the jobs picture, you've seen me show this slide over the last several years. After, let's see, here we are in October of 2021. The job losses kicked off in February of 2020. We lost 400,000 jobs at the trowel in April of 2020, and we're still short 91,000 jobs. So while we've been writing up revenues and we've seen our wage base expand considerably, we're still short 91,000 jobs, about a third of those in the hospitality sector. So please take note of that. Looking at the employment situation, knowing that many folks have not rejoined the labor force, this is a national discussion. We've been monitoring it for quite some time. We know that women were more deeply impacted, especially at the initial stages of COVID. As you can see here, that did bounce back. These are national figures. These aren't Maryland figures. The women being the purple line in this chart. We did see a resumption with the male side of it. More recently, there's been a bit of a split again. It's just for a short period of time, so I don't think it's anything to be deeply concerned about yet, but something worth monitoring. Of note is the 55 plus. And what we've seen is that our older workforce is not rejoining. Naturally, there are assumptions about why, part of it being the older workforce is more susceptible to the worse symptoms of COVID. So there's naturally health impacts. Also, we hear that the incredibly high value of the stock market has benefited those with 401ks to where they can think about removing themselves for a period of time. Nonetheless, it is deeply detrimental to the labor force. The 55 plus group typically comes back to work. They are highly experienced and highly productive. So we do hope to see an improvement in that category, especially as more folks get vaccinated. Looking at wage growth, and this is more just history here, we have seen a significant increase in wage growth beginning at the start of 2021. We saw that the official data goes through only the second quarter of 21. Our withholding data shows that it has continued up until this day. We are seeing withholding growth of around 8%, which is truly amazing given that we are still, again, 90,000 jobs short. Naturally, some of this, in terms of its purchasing power, is being reduced by the ongoing persistence of some of the inflation figures. And I'll touch on that a bit more later. But nonetheless, our tax receipts are not, they're nominal. They're not reduced by inflation. So we are seeing very strong growth in the wage base. Here are those withholding numbers. It's a bit noisy here, but I'll draw your eye to the very right side of the chart. And again, point out that on average in 2021, withholding's been growing about 8%. To put that in perspective, pre-COVID, withholding was growing about 4% to 4.5% in a good quarter on average. So a significant boost in the rate of wage growth in the state. Driving the income tax adjustment that I showed on that first slide is tax year 20. We are scoring tax year 20 at being up more than 9%. So a global pandemic, and in that year, tax growth is just under 10%. The orange bar is adjusted for law changes, and that's the one to really focus on to look at trends in underlying income growth. It's our strongest growth year in more than a decade during the pandemic when folks lost jobs. We now know we've seen a lot of money come in since September. The returns are due on October 15th, and that's when you get more of your higher income filers. We are quite certain at this stage to really echo what we've been saying throughout this, that our high income earners did extremely well in 2020. This is likely due to stronger business income than they probably expected, as well as strong capital gains realizations as the stock market has done quite well. In addition to income growth, we've seen savings growth. This is a national chart. The blue line is disposable personal income, and it goes back quite some time to show trends. The blue line, as you can see, never actually decreases during COVID, during 2020 and into 2021. If anything, it's accelerated a bit. The orange bars are the national savings rate. And pre-COVID, we were at about 7.5% as a normal rate of savings. You can see that it picks up significantly during the COVID period. Some of that is a lack of ability to go out and spend money. Some of that is saving, and it reflects the risk perceived by consumers. And it also shows those extra dollars, that federal stimulus flowing through. Folks saved a lot of it. What we could call excess savings, if you assume the old savings rate at about 7.5%, there's been more than 2.5 trillion saved by consumers during this nationally. Something to point out here is 2021 Q3. While it is lower, that savings rate, than what we've seen at times when the stimulus dollars were intact, it's still elevated. So what that tells you is a lot of consumers still are waiting on the sidelines. They still are risk averse. They're still uncertain. So not only does this chart really illustrate that there is a lot of money sitting on the sideline still, it also shows that consumers still are a bit hesitant, and we're not back to normal. And that's important to remember. Looking at the sales tax, I showed you at the beginning that we are recommending a pretty significant increase to the sales tax. It's based on year-to-date. Year-to-date sales tax receipts are up 22%. We have 4 months of data in this fiscal year. They are up 22%. We're comparing to the fall of 2020, which was absolutely impacted by COVID. We were beyond the sort of shutdowns of the early phases of COVID. Things were open in the fall, but absolutely consumers were hesitant. So we are comparing against a weaker period, but this is even strong growth over pre-COVID months, one. And two, we had been assuming 12.6% growth. We were expecting strong growth. So really what we're recommending here, again, is a continuation of understanding some of the money that is now already in the door. This is, we have a high level of confidence in these revenue estimates. The money is in the door. We really are continuing to adjust to those federal dollars and how they're flowing through our revenue structure. So that really defines what's driving these estimates. I do want to point out some of the risks, just as always, to moderate the expectations a bit there. One, this is a chart from the Federal Reserve, and it shows the net assets by different wealth percentiles. So not necessarily by income, but by wealth. And these are the way the Federal Reserve defines it, not anything that we've done here. But they rate it by the top 1%, the next 9%, the next 40%, and the bottom 50%. This chart indexes to 2019 Q4, so pre-COVID, and shows that wealth has increased for everyone in these cohorts, but to the highest degree for the bottom 50%. I think that's very meaningful. Now, of course, they have less wealth to grow. So in terms of dollars, it's much more significant for the top 1% and the next 9 and the next 40. But proportionally, the bottom 50 has received a fair share, a significant share of the federal dollars, and are driving a lot of the expansion afterwards. Now, it's worth taking a look at where that money is.
Andy, can I ask a question about this one?
Sure, please.
Net assets for wealth percentiles. Obviously, if you don't have much wealth at all, and you get something, say you have $10,000 and you get another $5,000, that's 50% increase. That's a very large, but it's what I find astounding here is that blue line going up so much more, that is the top 1%, than the middle, than the rest of us. Am I reading that correctly? Or
you are reading that correctly.
So that gap is between the top 1% and the next 99% is growing really significantly. And that blue line are the people who have the most to start with. So the fact that they have the most to start with and the incline is so steep, steeper than others, it seems to me the real story here. Although it's true that the bottom 50%, we're certainly helped by the federal action, and that's terrific.
Right. You're spot on, and the makeup of their wealth is very different, right? The top 1% and even the top 10%, much more of that wealth is concentrated in real estate and the capital market stocks. And those have done considerably well through the federal stimulus as well. So you're exactly right. In terms of dollars, there's, absolutely it's accrued to the higher ends. But you hit where you were headed there is exactly sort of the point I want to make with the next slide. Did I answer your question? Are we good to?
Yeah, no, I just want to make sure I was reading it correctly.
Sure. Mm-hmm.
Thanks.
This looks at the same indexing for just the bottom 50% and looks at how that wealth has fared. And you'll see on that end, it is in the checkable deposits and currency. It's in their bank accounts. It's not as concentrated in capital assets. And this is why I put this as a risk factor. The assumption is that a lot of this money will be spent down over time. And as this money is spent down, what you're likely to see is those checkable deposits will become profits that accrue to the owners of the capital, right? So the top 1% and the next 9%. So that, I think I was exactly headed where you are, which is that this isn't over. This money is still circulating through the economy. And just through the nature of how the economy works, more of this money over time will flow to the higher end still. And I think it's something for the policymakers to be aware of, whereas folks may feel a lot better at their current situation. It is going to evolve with time, is our belief. The risk on the revenue side is that as these folks spend it, will they spend it on rent and gas and electric, or will they spend it on taxable goods? And as it does accrue to the other wealth percentiles, will they spend it or will they invest it? So there is still a lot of uncertainty regarding how the federal dollars will continue to flow throughout the economy. And that is both a positive risk and a negative risk to the forecast. It could be seen in either direction. I think we've carved a very reasonable path there, but it does create the potential for volatility, especially in the sales tax. Inflation is the story of the day. You can't go to any website without reading scary stories about inflation. A prominent member of the Revenue Monitoring Committee, I think, put it very well that economists have a different frame of reference when it comes to time. To us, short term is anywhere from a month to 2 years. We have a very extended period for what the near term is. And our expectation is in line with the Federal Reserve's. We do believe that much of the inflation is supply chain related and will prove transitory. We do think that we'll see higher rates of inflation over at least the next year. But then we will come back towards the Federal Reserve's targets at that 2 to 2.5% range. This is a reading from some very respected institutions. You have the Treasury break even, which is effectively a market. So this is what the markets are saying. They expect inflation to be 5 years from now. You have two different branches of the Federal Reserve and Moody's Analytics. So Mark Zandi, who I know that we all respect considerably. So the expectation is that inflation will come under control over the next couple of years. And I think that's important to note, and it is assumed in our forecast. I want to point out capital gains. The most recent history that we have is in 2019. We're always playing from behind with information here, but you can see that the scale of capital gains has eclipsed where we were back pre-Great Recession. This makes sense given where the stock market is, but it's also worth pointing out that we know in 2020 that we've seen considerable growth from our high income earners. We expect that to continue, and there is every reason to expect that to continue in the near term. But we also know that when asset prices are where they are, eventually there is a correction. We cannot time that. We don't know the magnitude of that. It would be irresponsible from the revenue side to assume that that might happen next year. We wouldn't want to cripple the budget from that purpose. But I do believe it is this body's responsibility to point out that on the structural side, much of our tax revenue right now is coming from a base that traditionally is very volatile. And I hope that the budget side of the equation will take that into consideration as they approach their reserves. So in summary, I always end with risks, but I want to come back to this bullish picture. I am very, very bullish about the economy and our revenues in this 2-year picture. There's absolutely uncertainty. There always is. It is probably heightened right now because of the revenue on the high income earners, but I think we should be quite bullish here. Inflation can be directly positive for revenues. That's important for everybody to understand. Even if inflation is going up, it absolutely is. That is boosting our revenues. It's going to show in the sales tax. It's going to show in the income tax. We have to be careful also on the expenditure side. It's probably going to creep slower into the expenditure side. But just as revenues go up, I would expect everything that the state has been buying to go up as well. So it's not to say that we're going to have a ton more purchasing power. It's something that needs to be monitored. And that concludes my presentation. So again, strength of the economy, strength of the employment market as folks come back to work, and continued strength in the revenue picture. And I'll be happy to take any questions.
Good news.
Okay, thank you. Alan just saved his job there by unmuting me. Yes, thank you, Alan. And Andy, thank you very much. On behalf of my colleagues, Treasurer Kopp and Secretary Brinkley, I just want to start by thanking Mr. Schaffel for the outstanding work over the years that he's done in preparing these reports. This is, frankly, Mr. Schaffel's last presentation as director of the Board of Revenue Estimates, because he's going to become the agency's deputy comptroller in the near future. And during his time as director of the Bureau of Revenue Estimates, Andy's built the trust. This is so important, built the trust and admiration of colleagues, legislators, and stakeholders by working tirelessly to develop precise revenue estimates, accurate fiscal notes, and important economic additions, such as the need for caution. Andy, I just want to thank you and the entire BRE staff, along with the Revenue Monitoring Committee, for their thorough work in drawing up these estimates today and over the years. It is never easy. Your professionalism and expertise allow us to make responsible, tough decisions that strengthen our economy, ensure our long-term growth, and safeguard the people of Maryland. The COVID-19 pandemic has made revenue forecasting incredibly tough, but you and your staff continue to do a tremendous job. I thank you personally for the incredible work you've done to prepare all these reports and everything you've done as director of the Board of Revenue Estimates. And as Andy noted in his report today, this board is being asked to approve recommendations that would increase our September 2021 revenue projections for fiscal year 2022 to $21.6 billion, representing an increase of $495.2 million. Additionally, we're revising our September estimate for fiscal year 2023 to $22.8 billion, an increase of $542.6 million from our previous estimates. And I will be making that motion when I finish my comments, and Treasurer Kopp and Secretary Brinkley have comments also, and we'll make that motion. These are tremendous numbers, prompted by the record amounts of federal stimulus that Maryland has received. And if I could put in a plug for the Comptroller's Office, strategic decisions made by government, including my office's decision to delay the tax filing deadline for 2 consecutive years. Only state in the union to do that. That allowed tens of thousands of small businesses to keep as much money in their pockets and weather the economic storm as possible. And then they were able to pay, and we had a surge of small business revenues in July of both last year and this year. This report reflects our state's overall economic recovery, but always, as always, the devil's in the details. We know that so many of our fellow Marylanders and thousands of small businesses continue to struggle and still feel the economic consequences of this pandemic. As Mr. Schaffel noted in his report, today's numbers have been adjusted to include several factors that have occurred in the past few months. Obviously, the state's money benefits greatly from the federal stimulus money and its effect on the economy. And today's report is good news for the state's bottom line and underscores, I think, the strong economic bones of our state and our overall ability with the legislature and the governor and all of the economic experts in the state to plan and protect ourselves from hard times. I do want to note that today's report of good economic news does not represent, however, the experience of many tens of thousands of Maryland families. While our overall economy is improving, many of our fellow Marylanders, especially our low-wage earners, continue to suffer from the effects of this economic downturn. The consequences of this pandemic have only highlighted the economic divide which existed before COVID-19 forced our economy to shut down. And for so many of our friends and neighbors who are in low-wage jobs, they continue to suffer to this day from the devastation, financial devastation, and public health devastation. As Andy noted, we're still down an estimated 91,000 jobs statewide from where we were pre-pandemic, with more than a third of that group coming from our food service and accommodations industry. My experts estimate that 40,000 small businesses shuttered their doors for good since the start of the pandemic. That's far too many people who are still trying to figure out how to keep a roof over their head or how to feed their children. And I just want to, this is probably just a basic idea for everybody in the state if you ask them. We want to make sure that as we build back better and recover with these great numbers, that we don't forget these people. Through today's report, the September estimates and the fiscal year 2022 closeout, the state of Maryland is in an unprecedented fiscal condition where we have nearly $6 billion in unexpected revenue after we write these up. That's $5 billion that we reported at the last meeting, but now we've added $1 billion. That's $6 billion. Now, it's not ongoing money rolling in. We've got to discipline ourselves to realize that this is likely one-time only money and will just diminish as we get farther away from the federal relief. And federal relief has been essential. Earned income tax credits that the state put in were a good start, but I really think we can and we must do more. No one, colleagues, has asked for my opinion, but if I could offer 2 cents of advice to everybody who's involved, because this is a once-in-a-lifetime excess of revenue. And I would just like to suggest that I think there's some common sense as to how we should allocate the $6 billion. I think we should take half of it, as the governor has been indicating, or perhaps others have thought about half of that $6 billion and put it in the rainy day fund. I know that's been increased to $1 billion already, but we should add $3 billion in because we're really uncertain as to the long-term situation. And the difficult and painful decisions we've had to make in the last year underscore, I think, the need for us to have a really robust rainy day fund. Part of the sugar high that we've experienced with the influx of federal dollars and revenue surpluses triggered may prove temporary, and we must prepare, I think, for the next economic downturn, because that day, just like gravity, that day is going to come again. Second, with tens of thousands of our friends and neighbors continuing to struggle, many of them low-wage earners, as I mentioned, I think we're in a strong enough financial position to offer a second round of economic survival payments, this time $2,000 payments. These payments would not only serve as a critical, much-needed financial lifeline, but an effective economic multiplier for our state's economy. And so $3 billion in the rainy day fund, $1 billion approximately to these low-wage earners. We can and should, I think we could do this immediately. My office stands ready to, once again, immediately disperse the payments to the Marylanders who need the help the most. And once again, I emphasize to all the other Marylanders that this would help everybody because it buoys up the economy. because of the multiplier effect. And then thirdly, I think we should explore an aid package to businesses and industries that continue to experience challenges in recovering, or businesses that have closed down during COVID but are looking to reopen. And in particular, we need to pay a special focus to MBEs and to minority-owned businesses and to women-owned businesses who have borne the brunt of the economic consequences from COVID. So some reasonable amount can be, I think, continue to be dedicated to them. And then finally, I'd just like to say something on behalf of child care providers. These are 7,000 to 8,000 small for-profit businesses, largely owned by women and minorities. And they are absolutely essential to the state's economy, because without them, our low wage earners have no place to put their kids and can't come back to work. And they've been the hardest hit by the pandemic. And there have been unsung heroes during this emergency, and 750 of our child care facilities have permanently closed. I don't think people realize that. And it was due in large part to the government's failure to disperse much needed in a timely, efficient fashion the relief checks. So without access to affordable and reliable child care, our economy cannot flourish and our recovery will be prolonged. We can and should devote a portion of this historic $6 billion to provide immediate relief to our child care operators and identify and codify additional measures to streamline their operations, remove unnecessary bureaucratic hurdles. And I would strongly recommend that the policy folks consider establishing a separate standalone agency to oversee child care facilities. These are small, not-for-profit, for-profit companies. These are not the normal folks that sometimes our bureaucracy has to deal with. Now, everything like this may sound like an expensive wish list from the state's chief fiscal officer, and I pride myself on being tight with a dollar. But there's plenty of money that would be left over, I think, from the $6 billion for the governor and the General Assembly to invest in programs and services, other ones that they see fit. And I'm sure they're out there. There's some great ideas. But modernizing and creating a true Maryland-proud child care system, I hope would get upwards of $1 billion in this money. And I think it would be well advised and benefit, once again, the entire state's economy. What I'm focused on right now is our low wage earners, our small businesses, and child care, because without them, not everyone can share in the economic prosperity that the top 50% are experiencing, or as the treasurer noted, the very rich. If we work together, we can quickly put money into the hands of people who need it most. We can restore people's faith in government, which has been colossally failed, I think, many of them, because of things that can be corrected, delayed payments and excessive paperwork. Today's report allows us to be confident about Maryland's overall fiscal picture for the next 2 years, but we need to exercise caution, as Mr. Schoffel noted. This pandemic and everything that is brought with it has shown us that even smart planning and projections can change in an instant. And our state's greatest strength is its people. And I believe we should invest in them now and take precautions to ensure we can continue to invest in them even when we hit hard times. With that, I'd like to turn it over to my colleagues, Treasurer Kopp and Secretary Brinkley, for any comments. I apologize. Generally, I'm even briefer than this was a particularly long comment because it is a particularly large, important, one-time only money. And we need to make sure that we buffer ourselves against future conditions of gravity, I would say, because what goes up sometimes comes down. Madam Treasurer, I'm delighted, or Secretary Brinkley, whoever would like to go next.
Let me just add, Comptroller, to what you said. This is obviously a very unusual situation, projecting an increase of $1 billion over the next fiscal years, on top of an increase in the past. And this is just the general fund. This isn't the money that's going into the education trust, to other special funds, or the federal funds for that matter, the direct federal funds. So I must say, as I leave office the end of this week, this is a pretty good revenue estimate to be going out with. I came in 2002; it was not so good, not so happy. This is very good, but I think also that a couple of points that I would just like to reiterate that you made: the difference between the impact on the top 1%, the middle, and the lowest is just painfully dramatic. And while the federal infusion of funds did help very significantly, and the things that the state did, including what the comptroller's office did, helped significantly to those who need the help, that money can run through very quickly. People need money for rent, for daily living. And I do think we have an obligation as a community to try to narrow that gap. It is not a good sign that the gap is growing. It's it has to be narrowed. It's just inclusion of everyone in our community is such an important thing. And I would also point out, as the comptroller did, this is not necessarily ongoing increases. We've been through this in years past. This is not a structural increase. There won't be an increase of $1 billion or every time we look at the estimate. So I do think some of it, I agree, should be held in reserve, and some of it to be used, Mr. Secretary, for one-time expenditures, not built into operations. Our infrastructure is badly in need of support, and we have to make investments to make it sustainable, both in terms of repairing what we have now and making sure that what we build for the future will last for the future. Just that capital construction is just terribly important, and this is an opportunity to right size and restructure our infrastructure without incurring increased cost, and in fact, probably leading to savings in building and in energy. So I would really hope that the legislature and the governor, who were the ones who are going to make this decision, do look at this capacity to make one-time infusions, ranging from the school buildings to the total state infrastructure, and make it sustainable for the future, and to reinvest in our communities. I want to thank you again, Andy, for the workmanlike job. I must say, even with this great infusion, we came in so close to the target that you and your staff projected that it should make us feel really quite good about our capacity. And with that, I thank you all, and it's been swell.
Well, good afternoon, and thank you, Mr. Comptroller, Madam Treasurer. They really are some phenomenal words. Ordinarily, this is the point where I would thank Andy and the entire revenue estimate team, but that's going to be second on the agenda, because I do want to congratulate the Treasurer on Nancy on your decision to pursue so-called active retirement, I think is the one way that you put it, and turn the page on the next chapter of your life with Robert. And thank you for the decades of your selfless service to the state. Yeah, the comptroller made excellent comments earlier that I referenced about his 35 years of service with Nancy. Mine go back 27 years, but our work these past 7 years in all of our various roles have been excellent. I do think that we set an example for Washington to look toward, where we advocate for our positions, sometimes which are 180 degrees apart. Yes, you sat across the aisle from me, but sometimes we were literally on the other side of the aisle from each other. But all of our interest and motivation and direction was for the state and the state's citizens. In fact, one of the things I learned coming to Annapolis is that we all have more interest in common than not. and that we work very hard in those areas of our common interest. And the sooner we recognize and embrace that, the better for everybody. I met Nancy as I did the comptroller in 1995 when I was sworn into the House of Delegates. And we have served in many capacities over those years. The comptroller mentioned a lot of those here on the board of revenue estimates. One of our more frequent meetings were on the board of trustees of the pension system, which I really, really loved. The Capital Debt Affordability Committee, and in my interactions with the governor on the board of public works, and especially, I don't want to minimize this, but your work and on our calls with the rating agencies. I don't know that a lot of the people watching really can appreciate the teamwork that goes into having those calls with the different rating agencies. We're prohibited from having one call with all three of them, as used to be the case. We have to make separate presentations. And, you know, she's used to hearing me wrap up in my salesman capacity, requesting the AAA bond rating. Because when we reach that, we do save the taxpayers a lot of money going forward on just the cost of what it takes to borrow. And Nancy and her team has been central in organizing those calls and making sure that those are very successful. So, and finally, I guess, Nancy, I want to thank you, and this is you personally, for being the gracious person that you are and for the standard that you maintain for everybody. And I always like to think of this in terms of new legislators when they come in, but let's just say everybody to aspire to. And I do mean that sincerely. I reiterate, we might be having a little bit of a love fest here, but you and I were opposite angles on many, many issues. But again, we could wrap our arms around where we did see a common interest and try to move forward. And I truly respect you for that. And I thank you. It was that same.
Can I just interrupt to say that I hope Treasurer-elect Davis, former Chairman Davis, is still on this call, and I know that he will be a great team member. And I assure you, I look forward to watching and cheering from the sidelines as you go forward.
Excellent. And she has my cell number, so I know that I'll hear from her when she doesn't agree. And it's great that you brought that up, because that's a great segue to the next part. In that same year, and in that very same chamber where I met the comptroller and the treasurer, I met the incoming treasurer, Derek Davis, and I congratulate him on his election. He and I have had several different conversations about trying to ensure a smooth transition, and we're prepared to assist in any way that we can. But congratulations, Derek, on your election and the trust shown to you by the 188 members of the legislature who he reports to. So while that may be the technical path to being the state's treasurer, we all know that we are all acting in a fiduciary capacity to the citizens of Maryland. And as I'm sure the treasurer has said to Derek many, many times, you have an exciting adventure in front of you. I've tried to impress that upon him since I came here from the legislature too. And I'm prepared to work with him and his team in any way that I can to ensure success for all Marylanders. So Derek, welcome aboard. So second on the agenda. Now I congratulate Andy and your team. Check. You know, that was my original script. Now realizing that this is also his last meeting in this capacity. Seriously, Andy, I do want to thank you for all that you've done in all these years in this role. And congratulations in your new exciting role as Deputy Comptroller. He too has a great future ahead of him. So now let's get to the business at hand here. These new numbers, $495 million for FY22, the current fiscal year, and $543 million for FY23, a combined nearly $1.04 billion, certainly helps provide a cushion as we continue to grapple with the personal, the professional, the economic, the social, and our community impacts of the ongoing coronavirus pandemic. Caution is still the operative word, especially when you look back over where we were 21 months ago. The pandemic started having its massive impact on Marylanders. We were all hammered with economic shockwaves, and students were still not in the classroom. But as the winter wave of infection was still unknown to us at this time last year, as is this one that we're going forward with. I point all this out so we can also look back at where we were and acknowledge our progress, especially now that vaccines are available to every person in the state and the nation. And our challenge in this arena is now about convincing people to get the vaccine, not whether they can have access to the vaccine. We now have another variant, so we have to recognize that we're certainly not out of the woods. And if anything, the operative word going forward, you've heard this from the other members of this board, is volatility. And just as we revise these numbers upward, something as yet not determined can force us to revise them again, potentially even downward. So we're therefore going to ensure the state can be adaptable to whatever arises in the future, both positive and negative. I also point out that none of this just happened. There are many, many dedicated team members of the state, the healthcare systems, our emergency service providers, the private sector, you name it. Everybody had to come together to make things happen. But we do have the resources now to deal with some of the impacts. We maintain our lines of communication with the legislature and constituencies to ensure that we spend these resources from the federal government in full compliance with the feds continually changing their guidelines. We think we're pretty well set now on where we are with the recent changes, but again, we have to keep tweaking this model to make sure that it's efficient and responsive. And with this increase in revenues, we can also look at opportunities to maintaining Maryland on a steady but reliable trajectory in our recovery from the impact of this virus. As the governor said it in September, Maryland is experiencing one of the strongest health and economic recoveries in the nation. And he went on to add that Maryland will continue to practice fiscal discipline while prioritizing relief that advances our recovery. And these revised numbers are positive and give us added resources to accomplish these goals. And Madam Treasurer, I think everybody will be pleased to see some of the investments that we're going to recommend, because you're right, there is an opportunity to make some one-time fixes to some things that we've all known about for many, many years. And when we do that, there will be benefits for generations to come. So again, thank you, Nancy. It's been a pleasure to work with you in this role. And I certainly look forward to working with Derek, the incoming treasurer, in this role going forward. So having said all that, Mr. Comptroller, I defer to you for the purposes of making a motion.
Thank you. I appreciate both of your comments. They're terrific and eloquent and absolutely on point. And, just take care of that $6 billion, because I think Treasurer Kopp and Secretary Brinkley, everybody's on the same page that we want to buffer the state, but we also want to invest in the state. So thank you for your comments. I would like to make a motion to adopt the December general fund estimates of $21.592 billion for fiscal year 2022 and $22.789 billion for fiscal year 2023. Is there a second?
Second.
Is there discussion? Is there all in favor? Please say aye. Aye.
Aye.
Fabulous. Nobody's opposed. And thank you very much. That's the conclusion of the Bureau of Revenue Estimates, Board of Revenue Estimates meeting. Mr. Schaffel, thank you and your team tremendously. And Secretary Brinkley, good luck. You've got a significant job ahead of you, and delighted that the treasurer-elect was able to join us and can obviously be a crucial bridge to everyone. And I couldn't agree with you more that what separates Maryland is that we have a collaborative approach to these revenue estimates. We're not giving a Democratic version or Republican version. We're just giving what we think is our best professional view of this. And Secretary Brinkley, I think you represent something very special in politics. And good luck in the upcoming session.
Thank you. Thank you.
Thank you. That's the end of the meeting. And thank you very much for joining. Andy, please thank your team again.
Will do. Thank you all. Thank you, board members.
Bye.